The New Orleans Conference, the world's greatest investment event.
Thank you, sir. Thank you for that kind introduction. Good afternoon, ladies and gentlemen. I hope today's been pleasant for you. I've had the good fortune, like many of you, to be down here. I think this is my 31st year at the New Orleans Conference. So I've been here a long time. I've derived a lot of benefit from it, and I see a lot of familiar faces out there. I know you've all derived a lot of benefit from it. Many of you remember the founder of the New Orleans Investment Conference, Mr. James Blanchard, an important man in my career and a very good friend. And I'd like to dedicate anything that I say that you enjoy to the memory of Jim Blanchard, who founded this fine conference. Anything that I say that you don't like, the blame will rest with me. But I'd like to remember Jim specifically. He was a wonderful human being, great friend of gold, great friend of America, and a great friend of all of y'all. I'd also like to take this opportunity before I speak to thank the staff of this conference. As some of you know, I put on my own conference. It's a hellish amount of work. It's like herding cats, making sure you all get fed and watered, and all these dilettante speakers show up on time, that the hotel doesn't steal from people. Anyway, and Brian London, of course, is responsible for the fact that this conference survived the death of James Blanchard. So what I'd like you to do is join me in a round of applause for Brian London and the staff of this fine conference. Thank you for that. An experienced speaker makes sure he gets one applause line during the speech, and I just tricked you into giving it to me. Many of you know Sprott. How many people here are Sprott clients or shareholders? Raise your hand, please. Oh, this is great. This is great. So in Southeastern parlance, I'm not trying to expand the congregation. I'm just passing the collection plate through the choir. It's a wonderful circumstance. Sprott, for those of you who don't know, is a publicly listed company in Canada. We're domiciled in Canada. We manage or administer about $12 billion worldwide, focused exclusively on natural resources and precious metals. We have lots and lots and lots of products, but that's not what the speech is about. We'll go on to that. I want to start very briefly by describing the resource thesis to those of you who haven't had to suffer through this part of my speech before. The truth is that the keys to investing in natural resources are only twofold. One, natural resources investing is in effect investing in the ascent of man. There's 7 point something billion of us on Earth, and occasionally we do what people do, and that makes more. And those people who are born want to eat, they want to drive, they want to live like you live. And the bottom of the demographic pyramid, as they get more wealth, spend money on stuff that consumes resources differently than us. Most of us already have too much stuff. But the 2 billion people at the bottom of the demographic pyramid, as they get more money, they eat better. They might upgrade their roof from thatch to metal. They might upgrade their transportation from shoe leather to a bicycle, to a motorcycle, to a Toyota Hilux. In other words, their consumption patterns are extremely, extremely resource intensive. It's an important thing to know. Another thing to know, and I don't think I have to explain this to the veteran investors here, resource businesses are the most cyclical and volatile businesses known to mankind. Bear markets, in fact, are the authors of bull markets. I like to say from the podium that bear markets are sales. In fact, they're good things if you're looking to acquire assets. Of course, investors are afraid of bear markets, but that's their fault, not the market's fault. Bear markets are when things are cheap. The idea that you would buy low and sell high necessitates the fact that in markets like the markets that we've been through, you have the courage to buy. It's interesting to note that most people want to be contrarians when it's popular, which is a very difficult thing to do indeed. So remember this, the stuff of mankind is what resource investing is about. And the idea, the way that you make money, is to buy it when other people aren't. A circumstance that describes very accurately, I think, that the market that we have either enjoyed or endured, depending on your point of view, ever since 2011. Often when I come on stage, I talk about what I think you should do with your money. That's what Brian has asked me to do for years and what Jim asked me to do before that. Brian asked me to do something different this year. He said, Rick, I don't want you to talk about your recommendations for other people's money. I want you to talk about what you're doing with your own money. And so I'm going to do that with most of the balance of the discussion. with the caveat that what I do with my own money, of course, reflects my own means and my own needs. One of the things I've done from the podium here for some years is made fun of speculators in favor of investors. My wife pointed out to me that that was somewhat disingenuous because all of the money I now invest I made speculating. And so I will be talking about speculations, I will be talking about investments, but I want to say that this is really about what I'm doing with my money and may or may not be suitable to you. You will recall, some of you at least, that last year's discussion was about the successes that I had had personally and Sprott had had generally in two different arenas, really three arenas. The first thesis was that money could be made in resource bear markets, which we are decidedly in, by buying the very finest companies in the space. The ExxonMobils, the BHPs, the Nutriens, the RTZs, the Glencores, and simply waiting for time to do what time had to do in terms of commodities prices. That thesis has worked out reasonably well in the last year, and it's a strategy that will continue to work well, but that was last year's story. I also talked about, and you should consider, natural resource lending. One of the things that Sprott does is that we provide on-balance sheet financing for resource companies, particularly providing construction loans for new mines. The efficaciousness, if that's the right word, of that strategy is evident by virtue of the fact that the equity index among the juniors, the Toronto Stock Exchange Venture Resource Index, this is a great number, fell by 88% in the bear market. That is, that index lost 90% of its price, if not its value, over 5 years, while lending strategies generated 17% compounded annualized internal rates of return. A 17% return is attractive in isolation, but a 17% return annualized compared to an 88% decline is amazing, amazing outperformance. But again, that was last year's story. Finally, of course, last year we talked a lot about what we're known for at Sprott, which is private placement investing, the idea that you shouldn't participate in speculative stocks too often if you don't get a warrant to double your upside while minimizing the downside. Still a thesis that we like and still a thesis that you heard about many times from the podium. But, as I say, that was last year. Let's talk about this year. My own belief is that we're slowly coming out of a very bad bull market, and we aren't coming out of it with any particular strength. That tells me a couple things. It tells me that I need to be a bit more conservative with my speculative money than I would be at other times in the cycle, and I need to pick and choose my spots. There are 20 or 30 themes in speculation that are all at various points in time in the cycle attractive. The attractiveness has to do with how many other people are avoiding that sector, in other words, how unpopular it is, because surprisingly, the least popular sectors are usually the most attractively priced and will cycle into favor over time. So, in a very broad sense, in a very, very, very broad sense, there's three speculative themes that I want to talk to you about today. I should tell you that I will be allocating a really substantial sum of money over the next 12 months into each of these three categories. And the names of the investments I make will be available to Sprott clients and certain people who express an interest in becoming Sprott clients. The accounts that I'm talking about, the referenced accounts, will be in place beginning January 15th. And what I'm doing is actually establishing accounts at Interactive Brokers so that people in other countries can take advantage of this too under Sprott management. Those of you who are Sprott clients will be able to get the information associated with the names that populate each of these subsectors from your Sprott broker, or you can maintain a segregated managed account where we buy and sell the names on your behalf, beginning, we hope, God and the regulators willing, on January 15th. The first sector that really intrigues me for the next 12 to 18 months are a list of takeover candidates that we've developed. The truth is that the natural resource industry has shunned merger and acquisition activity until very lately for 6 or 7 years. They shun it because of the idiotic takeovers that took place during the last bull market. By our estimate, about $70 billion was wasted in the last M&A cycle. The consequence of that is that many, many management teams were allowed to pursue other employment opportunities as the shareholders saw the mischief that they had done in place. And the new managers were leery to engage in merger and acquisition activities lest they suffer the fate of the predecessors. The consequence of a long hiatus in merger and acquisition activity is twofold. The balance sheets and the income statements of many of the larger natural resource companies has returned to health, and in some cases, very, very robust health. So they have the ability now to do transactions if they want to. The second consequence of a dearth of activity, in fact, a dearth of investment in natural resources by large companies, is that the exploration pipeline and the development pipeline and the new mine pipeline of existing mining companies is at a low point that is in fact probably the most drastic of my 40-year career. Remember that every year that you mine a deposit, your business gets smaller. This business is in perpetual liquidation. None of us can stand at the mine mouth and pour in fertilizer and water and have that hole in the ground grow more copper. The truth is, if these companies aren't exploring, if they aren't developing, they are dying. And they have spent 8 years making insufficient capital investments, never mind to grow, but in fact to continue to exist. The consequence of that is that we are coming into an M&A cycle, the likes of which I don't believe we've seen since 2001. Our merger and acquisition criterion are several-fold. The first is that we need to believe that the deposit is a tier 1 or a tier 2 deposit. That is to say, we aren't interested in small, lousy deposits that will be bought simply because some issuer can buy it, something that happened in the last cycle. It has to be a deposit that we would like to own irrespective of the takeover. Importantly, we have to know who the asset is strategic to. In other words, we have to believe that the buyer will be doing themselves a favor buying it, as opposed to buying it for the reasons that happened the last time. The third criterion is that we have to believe that more than one buyer exists. What we have learned in prior takeover cycles is that auctions work best. That is, 2 or 3 or 4 people competing for the same asset. Very difficult, of course, to have an auction with one bidder. So we're looking for very good deposits, ones that we would like to own irrespective of a takeover, but where a takeover is much more likely than not, and where there would be several potential bidders in the course of that takeover. We now have a list of 34 candidates that we think qualify in this space. I'm going to winnow that list down to 10 or, with any luck at all, 7. The best picks out of this 34 company universe. And as I say, the results of this search will be posted on January 15th for Sprott clients or those of you who would like to be Sprott clients. In prior takeover cycles, early cycle, this has been probably the best speculative activity that one can engage in. The truth is that a good acquisition, some of you will remember years ago Francisco Gold as an example, where Francisco Gold was acquired for Glamis, by Glamis, pardon me, at a 40% premium, which was pleasant for the Francisco Gold shareholders. But the acquisition proved to be so accretive to Glamis and promised so much growth that after acquiring Francisco at a 40% premium, the shares of Glamis doubled over the ensuing 12 months. What you hope for, of course, is that double bump. A premium on being acquired, and then the acquisition itself causing the company that does the acquisition to go up too. And that is typical of early rather than late cycle acquisitions. The second area that I'd like to draw your attention to, and coincidentally employ my own cash in, is an old theme for me that I think is misunderstood. The royalty and streaming business is an extraordinary business. Let me give you some arithmetic to demonstrate how extraordinary it is. The top 7 royalty and streaming companies that we follow have generated 65% operating margins over the last 10 years, which means, in a gross sense, 65 cents out of every dollar that come in the door stick in the jeans pre-tax, as compared to the operating margins of the best and biggest mining companies in the world, where the similar number is 14%. That's a different way of saying that the royalty and streaming companies generate 4 times the operating margin that the operating companies generate. People say that the royalty companies are overpriced because they sell at EBIT multiples that exceed the EBIT multiples of the operators. It's easy to explain that away because they are 4 times as profitable while having no reinvestment requirement, no sustaining capital requirement, no upfront capital requirement. Suffice it to say, they are better businesses. Now, the knock that people have against the streaming companies, particularly the big streaming companies. How many people here were at the Wheaton lunch today? Congratulations, congratulations. I mean, that's a fantastic company. The knock that many people have against the Francos and the Wheatons and the Royals and the Prairie Skies of the world is that they can't continue to grow at the rate that they've grown in the last 10 years. In other words, you're paying a multiple for growth that doesn't exist. They're too big to keep growing. That's wrong. I compete with those companies every single day in the mining finance business. We lend at Sprott companies what you would call in construction development loans. And part of the new mine construction finance package is very often a royalty or a stream. Streams are unique in that gold and silver cash flow packaged as a stream trades in the market at a 15 times EBIT multiple, while base metals revenues trade at a 6 or 7 times multiple, meaning that a copper producer that sells the gold or silver stream to Wheaton Precious or Franco can sell that stream at a 10, lower his or her cost of capital at the same time as create a premium for the streamer, meaning in a billion-dollar transaction, there's 2 winners out of 2 participants. My suggestion to you is that given that the non-investment grade construction finance market on a global basis is between $12 and $15 billion a year, and because streaming, I think, will take about 30% of that, the streaming companies will continue to add assets at the $4 to $5 billion a year range for the next 10 years. In other words, the sense that this business that generates very high margins but can't grow is wrong. So we've now identified a list of 22 royalty and streaming companies worldwide in mining and oil and gas. I hope to reduce that number to 10. And again, the names in that will be published, I'm hoping, January 15th. Finally, I believe that we're coming back into an exploration cycle. As an industry, we have underinvested in exploration, I'm going to suggest to you, since the middle part of the 1990s, which means that the industry has either underinvested or misinvested in exploration for about 20 years. The consequence of that is twofold. When somebody makes a great discovery, look back to reservoir minerals in Timok or Hod Maden, the multiples that are paid for tier 1 exploration successes are mind-boggling because they're so scarce and because they're so valuable. The second thing is that money will now flow back into exploration because the big companies and some of the smaller companies have absolutely empty exploration pipelines. The best way, statistically, to participate in exploration is through the prospect generators. The truth is that exploration is a very, very seductive and very, very unprofitable strategy in the sort of broadest sense. There are over 2,000 publicly listed junior mining companies in the world. If you merged every one of those into one company, the resultant company, we'll call it Junior Explorco, in a good year would lose $2 billion. In a bad year, it would lose $5 billion. So what is the industry worth? Is it worth 6 times losses? 9 times losses? 15 times losses? What's the correct price-loss ratio? On the face of it, it's a horrible business. 1 in 3,000 mineralized anomalies becomes a mine. Why on earth would anybody invest in this, let alone suggest that you invest in it? I'll tell you why. 5% of the listed issuers, that is 5% of 2,000 companies, generate so much wealth that they add legitimacy and even luster to a business that in a good year loses $2 billion. Truly extraordinary performance. And there are several ways to beat the odds. One is to align yourself with serially successful explorers. Buffett famously says millions of people in the world can play basketball, but to win a game, you got to have a 7-footer. And you can identify these 7-footers, mostly because they stand out above the others, of course. And that really, really, really reduces the risk in exploration. But importantly, there's something else you can do. which is to understand that exploration is not at its soul an asset-intensive business. If it were an asset-intensive business, how could you explain away the fact that 1 in 3,000 anomalies becomes a mine? In the aggregate, these aren't assets, they're liabilities. The thing that turns them into assets is the intellectual capital of the people exploring them. When you begin to think of exploration as a research and development business, if you think of it like software or biotechnology, where people are answering unanswered questions about a molecule, then you begin to understand the essence of exploration. The real assets in these small companies are human rather than physical capital. And there is a small subset of explorers called prospect generators. These are people who use superior intellect to develop an exploration thesis, or hopefully more than one, develop a process by which they propose to test the thesis, and then bring in joint venture partners who fund the exploration. So they dilute their interest at the property level rather than issue shares and dilute themselves at the intellectual capital level. I realize this is a bit of a lengthy explanation, but it's important to set the stage. You'll remember at the beginning of this discussion, I said that when I was in university, back when these deposits were being formed, I'm afraid, the ascribed probability of success was 1 in 3,000. I have invested in 35 years in approximately 65 prospect generators. When I say approximately, one's memory fails after 35 years of activities like this, but approximately 65 prospect generators. I've participated now in 24 economic discoveries and 22 takeovers. If you look at a success rate of 22 out of 65, rather than 1 in 3,000, you understand the efficacious nature of this style of investment. I had a young intern, much smarter than me and much better at math than me, that suggested that the result that I enjoyed was 3 standard deviations better than one would expect in the market as a whole. This is really profoundly attractive mathematics. So to the extent that you're going to participate in exploration, and by the way, I would suggest to you that if you can, please do. The prospect generators are the place to be. Now, a special note about prospect generators. My own preference will be to participate in the prospect generators when I have the ability to participate in a private placement. Because discoveries are rare, magnifying the upside of the discovery in a private placement with a warrant is an awful lot of fun. A warrant, as you know, turns a 10-fold increase into a 17-fold increase. And when you look at any form of speculation, where the probability on any particular investment is failure, you need to know that your successes need to amortize your failures and leave over an acceptable rate of return. Private placements with the inclusion of a warrant is statistically the best way to do that. That notwithstanding, I will also buy the prospect generators in the secondary market. And that is the third sector that I will be allocating to personally. And again, the preferred list of prospect generators, and when I say the preferred list, they'll be the companies that I have actually spent my own money on will be available on January 15. So I want to reiterate very briefly why and what. Takeovers, because it's early cycle, coming out of a bear market. In my experience, the last 3 bull markets that I've been through, the early returns have come from takeovers. Royalty and streaming, because they are better businesses than other mining businesses, and because people believe them to be overvalued as a consequence of the fact that they can't grow, which is fallacious. It's wrong. They can and will grow, And prospect generators, because I know for certain that we're coming back into an exploration cycle, and the returns that I've generated in my own portfolio over the last 35 years with prospect generators is 3 standard deviations better than the result that would have been expected had I merely participated in the exploration market in the broadest possible sense. Now, as I say, the availability of this information begins January 15th. If you are a Sprott Global client, you can ask your Sprott Global broker about the names and how to populate your own account with that. We will also be doing segregated managed accounts that will give you the ability to track my portfolio on an automatic basis, and this all begins January 15th. I'd also, in the short amount of time that I have left, draw your attention to a couple of benefits that we have for you here at the New Orleans Investment Conference. How many people have been coming to New Orleans for 10 or more years, this conference, 10 or more years? Okay, and this is a lot of fun. This tome, prepared by Sprott. These are exhibitor stock charts. So every public company that's exhibiting over there in the exhibit hall, we have their one-year stock chart here. And this is free to any of you who want it. Come by the booth, we'll give it to you. It's a lot of fun. You know, sometimes you go up to an exhibitor and they just, you know, they're just the greatest thing since sliced bread. You know, this is happening and that's happening, and, you know, by God, they're going to go up tenfold next week because whatever. And it's really fun to listen to the story and compare it to the stock chart. Sometimes these wonderful stories have stock charts that resemble nothing so much as a topographic map of a ski resort. Straight decline from upper left to bottom right, and definitely double diamond. It's useful during one of these discussions that you're having with the ladies and gentlemen in the booth to compare the potential with the performance. In other circumstances, the charts tell a very different story. And I'm not suggesting to you that you do all of your investing based on technical analysis or charts. I'm just suggesting that the exhibitor stock chart, as you walk through the hallway, gives you an interesting point of discussion with the people that you are talking about. If you come by our booth and ask nicely, I know you're all nice people, the people in the booth may be willing to tell you which of the exhibitors in the hall I own, which may or may not be useful information to all of you. I would also, at this conference, suggest that for any of you, whether you are a Sprott client or not, if you would like your natural resource portfolios reviewed by me personally, if you give me a list of every resource stock that you own, you can email it to me or give it to me. I need to know both the name and the symbol, and if you email it to me, do not have it in an attachment that a 65-year-old can't open, okay? Have it in the text of the document, or contact us at the booth. This will not constitute investment information because I can't know enough about you to know what's proper for you. All I do is I rank the companies 1 to 10, 1 being the best, back up the truck, 10 being the worst, shoot on sight, and comment on the companies where I think that I have a comment associated with the company that is germane. I really like doing this. I found it's useful for customers that have a life to have their portfolios subject to adult supervision. It also tells me what my customers are thinking about, what sort of needs they have in their own portfolio. So it's really mutually advantageous. In summary, I'm doing some things with my own money that I'm excited about this year, and I thank Brian for having the foresight to ask me to talk about what I'm doing rather than what I think you should do. Those are, once again, takeovers, royalty and streamers, and prospect generators. The information will become available January 15th. We'd like to share it broadly if that amused you. The exhibitor stock charts, just come by the booth, pick them up. There's a lot of information here, and frankly, there's a lot of fun when you're walking around talking to the booth. And finally, if you want a no obligation portfolio review, come by the booth, sign up, leave me a card where I know how to get in touch with you, and we are happy to review your resource portfolios. Note I said resource portfolios. Don't ask me about defense stocks or insurance company stocks or anything like that. But your resource portfolios, I'd love to rank them for you, and I'd love to comment on them for you. Ladies and gentlemen, it's been a pleasure to be before this audience for 31 consecutive years. It was a pleasure to begin this speech by remembering the late, great Jim Blanchard. I wish all of you the very best of success in the next 12 months. I look forward to seeing you all here in New Orleans next year. And I want to remind those of you who are here for the first time, you can make some money at this conference. And if you put your mind to it, really put your mind to it, you can have some fun in New Orleans too. Ladies and gentlemen, good night and thank you.